Stephen actually put together something for all of you, and we found that one of the questions was really, really common. And so Stephen said, "You know what? Let me just take material right from my 3-day workshop." And there's a couple 3-day workshops coming up in a couple weeks. He said, "Let me take material right from my 3-day workshop so the audience can actually see how we teach these things and what the answers are." So in a moment, I'm going to invite him to share his screen and show us. But first, I'm going to pop open my screen and kind of recap what we did. It was 3.5 hours of pure gold, and we're going to give you the link here so you can watch the replay for a limited time. But here's what we covered. We did a pre-event survey to find out what's going on in the market. And Stephen, I know you were there, so this is no new information. You've seen this. For all of you watching, here's what you want to know, okay, is right now the right time to get started? What are the best strategies in this market? And what are the best properties to invest in? So we really focused on answering these 3 questions at the New Real Estate Advantage. So I really encourage you to go watch that replay. And then we asked everyone, well, what's stopping you from making meaningful progress right now in your real estate investing? Here are the top 5 things. So if you identify with one or more of these things, then you're in the right place tonight. And you absolutely have to watch that replay of the New Real Estate Advantage. So number 5, not knowing where or what to buy. Number 4, capital and financing clarity. Number 3 was lack of knowledge or a clear path. Number 2 is building the right team. So how do I find partners or service providers? How do I know they're the right people? And the number 1 thing that's stopping you right now is fear and uncertainty. You want to avoid reckless risk. You want to avoid making a mistake in this market more than you want to make money or get a high ROI. It's a really interesting market right now where you're more interested, most people are more interested in not losing than they are at winning. And so I think, and Stephen, we've done this for many, many years, training people, probably 45 years between the two of us, and at Keyspire, a couple hundred years between everybody that all of our coaches. But what we've seen is that in these markets where there is fear and risk and uncertainty and a softening of real estate prices, which is what people see at the surface, something happens. There's this duality where, number 1, there's the most amount of opportunity you're going to find right now, but also the smallest margin of error. So what I mean by that is, in markets where everything's going up, you could buy anything and you look like a genius. But in markets right now where things have stagnated and kind of they're bouncing off of the bottom a little bit, just waiting for that rebound, there's so much opportunity, but you have to be tight on the numbers. You have to know how to make that decision. And so Stephen's going to open up the night tonight with a session right from his 3-day workshop that really helps our workshop attendees on how to make that decision. Because if you can dial in that margin of error, if you can get the training to reduce that risk, you now unlock this sea of opportunity that is created by this New Real Estate Advantage. And so that was my intro. I wanted to tell you what's happening right now and what's stopping most people. If you identify with any of these 5, make sure you stay tuned in tonight and make sure that you watch that replay. And we have the 5-part roadmap: how to fund, find, buy, add value, and get paid with real estate, that we cover at the 3-day workshop. And we covered a little bit at the New Real Estate Advantage. So with that being said, I'm going to stop sharing here. Stephen, how do we help people make decisions? How do we help reduce that margin of error for our viewers tonight, and all of our attendees at the 3-day workshop? Let's see what you've got prepared for us at this 3-day workshop, and then we'll do some basket questions, and we will answer the top 20 questions that people have.
I love the basket questions. It's so analog, it's so great. And I don't know which one you're going to pluck, and you don't know which one you're going to pluck. So it'll be fun for us as well. And Michael, while you were chatting, if people notice, I turned to the side. It's not to ignore what you're saying. It's I see people are already in the chat inside of YouTube, and they're already asking questions, which are interesting, because if we do have time, we'll try to go in there and see what questions we have. But I often find that people put things in the wrong order. For example, corner of my eye saw a couple of words about, general partnerships and limited partnerships and stuff like that. And I think to myself, what do I care most about? How to set up my world or getting started in making money, and then I'll figure out things along the way. And I think one of the best pieces of advice I can give people is just to get started. In spite of fear, uncertainty, doubt, because they all manifest the same way, just get started. And then things will unfold as you go. The people that try to figure it all out in advance before they do anything, those are the people that are watching every cycle like this one now and saying, I wish the markets were ... Well, you and I wish for these markets, right? We sit up late at night waiting for these markets to manifest, just like people who are investing in the stock market wait for the dips in the market to take advantage. And yet most people don't buy in the dip, they buy on the way up, which doesn't always make sense. So what I put together, Michael, for everybody was more of a decision process, because with the confines of time that we have this evening, I definitely can't do justice to going and doing a deep dive on the analytics and running the actual numbers. We'll get into that in the workshop, line by line, section by section, item by item. So for this evening, what I thought I would do is just bring forward, I'm going to do what you did. I'm going to just load up a very, probably one of my shortest presentations ever. It's only 3 slides. And yet I want people to pay close attention to how much real gold is in this. And I'm going to help you figure out how to make better decisions. So with that, let's go ahead, and I'm going to just go right now and share the screen. I'm just going to confirm with you, Michael, that you can see my screen.
Yes, I can see your screen.
Fantastic. I'd hate to be talking for 5 minutes and people say things like, I can't hear you because I muted myself, or I can't see the screen, but it does happen. So the first thing I want to do really, as you look at this screen, right, at the first presentation, Scott McGillivray was here, and he introduced a framework that we use every single day called the 4 ways to win. And I'm not going to teach this tonight. Rather, what I want to do is show you how we use it to decide whether a deal even deserves a deeper analysis. And it's interesting because most people are taught to look at real estate through one lens. What's that lens? Cash flow. And if it cash flows, I buy. If it doesn't cash flow, I walk. And while it matters, while cash flow definitely matters, because it's not the whole picture, that's where things really change significantly. And inside the workshop, we evaluate every deal through 4 possible lenses, 4 possible ways that we can actually win. So if we think of the first way, the way that we all know, which is obviously cash flow. That's the first way. And not just cash flow, but positive cash flow. Then we come up with something called principal recapture. You know, every time we make a mortgage payment, a portion of that payment is principal, and a portion of that payment is interest. Often people never add up the amount of principal pay down and the buildup in equity. The third one is passive appreciation. And in that context, most people know this as, what is the market doing? How much is the market going up over time, and over what period of time? Many people don't even know that for the last 75 years or a little bit more, the Canadian real estate market has predictably gone up year over year, somewhere between 3 to 4% every single year. Now, some years are much more, some years are less, even some years are negative. But overall, it generates a 3 to 4% increase in the value of the property. And why that's important is, you know, if you pay $100,000 for a property and it goes up by 3%, that doesn't sound very good. But what if you only put down a 20% down payment on the property? Meaning you've controlled that $100,000 for only $20,000. Well, now when that market goes up by only 3%, it's the 100,000 that's going up by 3%, meaning it's 103,000. And what that means is that 3% is really a return on which investment. Well, you didn't write a check for 100,000, you only wrote a check for 20,000. And as a result, you made $3,000 on $20,000. And that's a 15% rate of return, not a 3% rate of return. So when we talk about passive appreciation, we have to think of it in terms of, did we write a check for all cash? And we're called a cash buyer when we do that. Or did we leverage the deal? And if we did, we're going to make a leveraged rate of return. And then, of course, the fourth one is active appreciation, which most people know as, what are we going to do to increase the value of the property? Are we going to renovate it? Are we going to change its use? Here are the rules that I want you to be aware of, and this is really important. A deal has to win in at least two of these, and it can never lose badly on cash flow. That one rule, that one concept alone eliminates a huge number of bad deals. So I want to say that again. A deal must win in at least two of these, and it can never lose badly on cash flow. So if you can do a deal where passive and active appreciation are fantastic, but cash flow is negative a lot, well, that's not really what I'm talking about. I'm saying it's got to be any two of these, but you really do have to have positive cash flow. Now, if you think about positive cash flow, a razor thin deal in positive cash flow, we often consider negative cash flow. If the deal is so tight, you're only making $25 a month, let's face it, something's going to happen that's going to eat up that $25. So that really does help us decide and determine whether or not the deal makes sense. So keep in mind that that rule eliminates many, many of the bad deals that I often see that are done when people ask me to take a look at their deal. Now let me show you how we reality check cash flow before we even open up a spreadsheet. And I just call this the 90-second cash flow reality check. I mean, how nice is it that you can actually analyze a deal in a minute and a half or less? I know so many people that are either seasoned investors, been doing this for a long time, or brand new investors, or never done this at all. They all tend to waste a tremendous amount of time putting in too much energy and effort in a deal that just isn't going to work out. And it was obvious in the first 90 seconds if they applied what I'm about to show you. So this is not a deal analysis. Let me be clear. This is just a filter. And we're going to ask ourselves just two questions at this stage. And the first question is, what is the verified monthly rent? Now, if I could highlight and bold and put the trumpets, it's going to be around the word verified. It's not what the seller hopes. It's not what a proforma tells you. It's not what a projection might suggest. It is verified rent. So once we verify that rent, once we know what that rent is going to be, that is our income. That is our source of income. The next thing that we really have to be as diligent about is going to be the all-in monthly costs. What are all of the expenses that are relevant? What are all the out-of-pocket costs that are typically in a real estate transaction on a monthly basis? So of course, you're going to have what? Mortgage, right? That mortgage is going to be principal and interest, or it might be principal. It might be interest only. It depends on the type of loan. But basically your mortgage, that's going to be one. Taxes, insurance, repairs, maintenance, vacancy, management costs. All of those things are going to have to be calculated as an all-in monthly cost. And so in this example, I'm showing, $5,000 a month coming in. This is a duplex, and $2,500 per unit, $5,000 per month. And we're going to have about $3,720 a month in all of our costs. That's going to give us a net cash flow of $1,280 about per month, or $640 per unit, positive monthly cash flow. So it's roughly $600 or $640 per unit as a positive monthly amount. Now, if this number were negative, or I go back to that question, if this number was razor thin before appreciation or before financing or refinancing, whatever the case may be, at this stage, depending on where we are in our comfort level, we might just kill the deal. If we are getting started, or if we're restarting and we have some level of concern, we're just going to kill the deal and move on to the next one as quickly as that. Now, of course, we can always get creative, and we can always look for ways to see what else we can do to either increase the income or decrease the cost and rerun the numbers. But still, it'll be inflows and outflows, right? The money coming in versus money going out. At the end of the day, that's exactly what it's going to be about. But this is how capital is protected. This is how mistakes are avoided. And this is exactly why people stop feeling trapped, because we not only ask this question, but we also ask another question. What happens if rates are worse than expected? What happens if things change? So some people have heard the term post-mortem, right? That is kind of a macabre term, but when things don't go well, we tend to look back and evaluate why things didn't go well. Well, what if I told you that there's something that we do that most people don't do, and we do a pre-mortem? What the heck's a pre-mortem? Well, we look at the things and we say to ourselves, okay, in 3 months from now, I've bought the property, I closed the property, I renovated the property. I'm looking back and the whole thing didn't work. Instead of that being reality, and you're really looking back post-mortem, why not look ahead pre-mortem and say, imagine I look back and nothing worked. What had to go wrong for that to happen? And then you get to see all the things that you didn't consider. And so we make sure that we have a checklist. We have some underwriting. We do our due diligence. All of the things that we need to do are in place. So we can say to ourselves, what happens if the worst or things happen negatively, worse than expected? What if the cash flow compresses? But if the cash flow compresses and still stays positive, you know what we call that? We call that survivability. When you can establish things that could go wrong, may not go wrong, but could, and then you pressure test that in advance, then you get to see what that range is of comfort that you have. And some people need more and some people need less. It really depends individually, but that's what we call survivability. Now, let me show you how this fits into the entire deal without actually teaching the deal. This is kind of cool. We call it a deal snapshot. You know, in the workshop, we're together for 3 days. I love to spend time on real deals, not hypotheticals. I mentioned it early on. I said $100,000, $20,000. Let's face it, you're not buying an outhouse in Canada for 100 grand. So let's not put those numbers on a house. What I like to do is I like to look in the few days before the workshop starts. I like to go looking for deals that the people that are going to be at the workshop are going to be looking for. And I go look for them in real time, just like I was you, except I'm going to use my knowledge and expertise to see what I can find. Now, frankly, I always find at least a dozen deals, and I always find them very, very quickly. But I'll select some of those deals and I'll put them up on the screen, and we'll do a deal snapshot. And we'll see together if the deal actually makes sense. So here's an Ontario-based duplex, could be anywhere else, but this one is a snapshot for an Ontario-based duplex. I want to be very clear about something before I show you all these numbers. This is not to impress you. This slide is not to blow you away or to impress you in any way. It's just here to complete the picture that we started talking about. And these are the facts. The purchase price is $625,000. Now, I want you to remember, this is an actual deal. This is not something that I just fabricated. The renovation and the other costs are going to be $75,000. Well, what does that mean? That means that the cost to renovate the property, the cost to close on the deal, the land transfer taxes, all of the costs associated with buying, acquiring, closing, and holding the deal, we've calculated at $75,000. And we've also looked at what is the after repair value. Once we fix it up, what is the new value of this property likely going to be based on comparable sales? And in the workshop, I will walk you through how to do this correctly, not how people typically do it and get into trouble because they over-evaluate dramatically or they under-evaluate dramatically. You'll see how to do this right. But the value of the property is going to be $749,000. That is what our expectation is. Of course, we're going to need some capital to control the deal. And that capital to control the deal is going to be around $200,000. So let's look at that number. And I always tell people that doesn't have to be your money. That $200,000 doesn't have to come from your savings. It doesn't have to come from your equity line of credit. Capital sources can come from a whole host of different places. They can come from joint ventures. They can come from other partners. They can come from, yes, your own cash, your own credit, your own equity, if you choose it to be. But often it's a question of a combination of a number of different things together. Now, once we have these numbers in front of us, which most anybody can see what the numbers look like, we're now going to take that filter called the 4 ways to win. And when we run the 4 ways to win, here's exactly what is going to happen. Number 1, it cash flows. Number 2, it recaptures significant principal. Number 3, it benefits from passive leveraged appreciation. And number 4, it also includes active value creation from the increased value in the property through its own renovations. You'll see a combination of dollars and percentages. The dollars are the actual hard dollars, and these are all the dollars that are anticipated in the first 12 months once you've completed the project. The percentages that you see beneath each of those dollars are the percentages of return based on the investment if you actually did use $200,000 capital. That would be the return on that capital invested. So as you can see, any 2 of which are pretty good. And then when we add the cash flow, that cash flow, if that is a number that makes you happy, because again, everybody is different, then it's a deal that you want to absolutely move forward on. Now, that doesn't mean that it's the end of all of that. But what's important is that no single outcome, no single one of these 4 carries the entire deal. And really, that's the point. Inside the 3-day workshop, we'll break down every one of these numbers line by line. So what I mean by that, we're going to break down every assumption. We're going to break down every expense. We're going to break down the income. So the income won't be just, for example, rent. There might be other income. There'll be fixed and variable expenses. So every decision, every item, we get to break it down. Tonight is not about teaching you how to analyze the deal. It's really about showing you how experienced investors decide before they commit. If at this moment you're thinking, hey, I understand the idea, but I couldn't do this yet on my own, that's exactly why the workshop was designed. So there you go. That's our decision framework. Michael, let me throw it back to you. And I'm sure we've got lots of people with lots of questions.
Stephen, thank you. Well explained as always. This 4 ways to win is absolutely amazing. When people say to me, Stephen, like, how do I do due diligence? What is due diligence? How do I, like, people get very afraid of due diligence. And I say, pause, take a breath. Let's run the 4 ways to win. And when we do that, I do that with my family, with my friends. I do that with our coaching clients. I do that with our inner circle members. Pause, take a breath. We'll do the 4 ways to win. And all of a sudden, everything becomes clear. And so when I see what you did there, That's super clear to me because I've been doing this for 25 years now with the 4 ways to win. But if you're watching and that seemed still a little fuzzy, don't worry. It's very straightforward. And that's, like Steven said, what we do at the workshop.